Hello, my name is Alan Kian. I'm a certified general accountant and the founder of Alan Kian CGA Professional Corporation. In this presentation, I will talk to you about financial planning for business owners. Most Canadian taxpayers pay more than half of their income to tax authorities in the form of income tax, sales tax, or even property tax. Therefore, your financial plan should take the above taxes into consideration. A business owner might be able to save over 10% from taxes by doing a proper financial planning. I have divided this presentation to 3 segments: drafting an expense budget, review income statement of business, and sole proprietorship versus corporation. The first step is to write down the expected family expenses. Here I am showing you a list of items you should normally put in your family expense budget. It is important not to put investments here, such as rental properties or stocks. For business owners, investments outside the business should normally be made out of the disposable income. Now, you need to take a look at the income statement of the business and see if it generates enough profit to cover the expenses listed in the previous section. If it doesn't, you might need to cut some of the expenses of the business, or in the expense budget, you might need to remove or reduce items such as RRSP and insurance. You might want to review your insurance policy with an expert, of course not with your insurance salesman, and see if you are paying too much. Another cost-cutting area would be reducing payments towards your residence. You might want to consider renting rather than buying. This could have a significant tax advantage if you incorporate your business. One of the reasons to incorporate is the tax saving. By incorporating, you have a flexibility to implement strategies to minimize combined tax rate. You will be able to transfer profit of the business to low-income members of the family and pay minimal tax. You will be able to keep the profit in the business and pay a low tax. Also, if you decide to sell your qualified small business corporation, you will be exempt from a capital gain tax up to $750,000. However, if the profit from the business barely covers your family expenses, from the tax point of view, incorporating might not make sense. Having said that, an established and sustainable business should be able to produce a healthy profit. Otherwise, you might want to review your business model and draft a business plan. Let's summarize the main points of this presentation. It is important to draft a family expense budget. A sustainable business will produce a healthy profit that not only will cover family expenses, but also have a residual earnings to accumulate in the business. When developing your financial plan, make sure to distinguish between expenses and investments. And finally, consider incorporating your business. If you have any comments or require some information, please visit my website at www.accountingottawa.com and contact me either by email or phone. Please also see my 2 other presentations posted here and titled Tax in Canada and Simple and Accurate Bookkeeping for Small Businesses.